Hello, everyone, and welcome to our annual halftime report. My name is Cassandra Lehman. I'm the president of Beacon Wealth Consultants and also a certified financial planner. And we're very happy to have all of you here today and look forward to sharing some important market information with you as we do just about every 6 months. Now, before we get started, here are some disclosures that we share to keep the regulators and the attorneys happy. Now, our goal today is to walk through some of the market fundamentals from the first half of 2017. Of course, it's impossible to cover everything that's happened this year so far, but we believe that a clearer picture comes together when we look at market fundamentals, despite what's happening in the news, both politically and with business. And so we're going to take a look at where we've been and where we are and where we're headed, and that can help guide the investing process. And with that said, here's what we're going to cover today. We're going to review the first half of the year in the markets. We're going to take a closer look at what drove the U.S. equity market performance. We're going to look at global markets and opportunities abroad, and then look at some predictions for the second half of the year. So let's start off by looking at what happened during the first half of the year. In the first 6 months, the U.S. economy continued its modest but steady growth. This economic expansion has lasted 95 months. Now, that's the third longest economic growth period in the 33 business cycles since 1854. The longest expansion occurred from March 1991 to March 2001, which was 120 months. And the second longest expansion was from February 1961 to December 1969, and that was 106 months. Some analysts believe that our current expansion has a chance to become the longest expansion in history. Let's start with a snapshot of the S&P 500 performance for the first 6 months of 2017. The Standard & Poor's 500 Index is a capitalization-weighted index of 500 stocks designed to measure performance of the broad domestic economy through changes in the aggregate market value of 500 stocks representing all major industries. The S&P ended 2016 at 2,239 and closed on June 30th at 2,423. So over the first 6 months of the year, markets marched to new highs on strong corporate earnings and tuned out noise from Washington. In June, volatility returned due to a tech stock slump, uneven economic numbers, and falling oil prices. And you can see the general trend of this graph head up at a modest angle with relatively few dips and jumps. Historically, the first quarter of the year tends to be softer, and we think that trend is going to continue this year. Over the course of the first 6 months, the S&P 500 performed well against expectations. It's recorded its best first half since 2013, rising by 8.2%. Again, staying focused on the fundamentals and not overreacting to marketplace hyperbole will reward investors. In addition to the strong S&P 500 performance, the Dow roared past 20,000 for the first time ever and registered 22 record highs in the first half of 2017. The Dow Jones Industrial Average, which we call the Dow, is comprised of 30 stocks that are major factors in their industries and widely held by individuals and institutional investors. During this run, U.S. companies reported their best quarterly gains in 6 years. The Dow's 8% first half jump is its strongest since 2013. And thanks to the tech sector, the NASDAQ rose 14.07% since January, its strongest first half numbers since 2009, although tech stocks did fall back a bit at the end of June. The NASDAQ Composite Index measures all NASDAQ domestic and non-U.S. based common stocks listed on the NASDAQ stock market. Each year, various media outlets compile many of Wall Street's top analyst predictions for the year ahead. These are January's numbers, and as you can see, experts predicted a year of positive returns. While they gave a range of results, one trend is consistent. Each analyst predicted that the S&P 500 would continue to rise in 2017. The forecasted average for the listed analysts was 2,368, a 5.8% growth prediction. However, actual S&P 500 finished the first half of the year at 2,423 for an 8.2% increase over the start of the year. Since January, though, many experts have revised their predictions. We're going to walk through some of the driving forces from the first and second quarter and revisit these numbers and revisions later in the presentation. Now let's look at some specific sectors in order to better understand how we got here. To put today's economy in perspective, let's begin by going back to December 2008 when we were in the midst of the worst financial recession in 80 years. So here you see 20 speedometers representing 20 leading financial indicators. 15 of the 20 are red, which correlates to negative or weakening numbers. And so you can see there's a lot of red on the screen. And I think this is always important for us to go back and really see how things looked when the economy was in a very, very bad position. By comparison, in January of 2017, 16 of the 20 leading financial indicators reported positive or strengthening numbers. Those appear in green. And although we've been talking about a softer first quarter, the market performed significantly better at the start of the year than during the recession. You can see that there is no red on this screen. And here's where we are today. 17 out of 20 financial indicators report positive or strengthening numbers. Since January, the global economic outlook has moved from yellow to green. And we'll look into that a little bit later, but first let's get a better sense of some key domestic financial indicators. A closer look reveals their performance and the role in this year's slow and steady rise. Corporate earnings may have been the single most important market driver in the first half of 2017. Corporate earnings were spread across the investment sectors, with energy leading the way. The first quarter earnings were especially strong as 75% of the S&P 500 companies beat their earnings estimates for an increase in 13.9% over last year's first quarter. This was the strongest earnings quarter year over year since 2011's third quarter. Overall, the second quarter earnings growth is estimated at a very respectable 8%, with technology, energy, and financial sectors leading the way. Technology stocks account for 22.3% of total S&P 500 stocks, the largest sector by far. For comparison, financials, the second largest indicator, accounts for only 14.5% of the S&P 500 weight. These numbers are based on company capitalization weighting. Now, for most of the year, tech stocks performed well. The sector has risen 16.2% since January, and major stocks within the sector have jumped nearly 17%. In June, however, the tech sector slumped amidst a stock sell-off. And while the analysts are still debating the causes, others are encouraging investors not to overreact. They suggest treating this downtick as a buying opportunity. Regardless, the technology sector will remain a key driving force in our markets. The graph shows both the year-to-date U.S. inflation rate and the recent Fed's interest rate increases. As you can see, the inflation rate has dropped each month since February and is now below the Fed's inflation target of 2%. Still, the Fed has modestly increased interest rates to tighten money. The Fed has suggested it will stay the course when raising interest rates, believing inflation will hit its targeted 2% on the back of continuing low unemployment. Rising interest rates generally tend to cool economic activity down, thus lowering inflationary pressure as borrowing becomes more expensive and consumers tend to save more. The unemployment rate in the U.S. is continuing to fall, reaching toward the lowest number in 16 years. In addition, there are currently over 6 million non-farm job openings in the economy, and jobless benefit claims are falling. These statistics point to a healthy labor picture. Consumer sentiment polls 500 households a month on their financial circumstances and economic outlook. The poll is important as it helps analysts get a grasp on consumer spending, which accounts for more than 2/3 of the economy. Following the presidential election, consumer sentiment bumped up significantly. In June, however, the numbers had their largest drop since October, suggesting consumer optimism may be wearing off. Still, the numbers are strong thanks to the labor market and rising household incomes. Strong consumer sentiment numbers don't always translate to strong consumer spending. From January through May this year, retail sales underperformed despite high consumer confidence and a solid labor market. While unemployment posted low numbers, average hourly earnings increases remained very modest, a 2.5% increase so far in the year. In other words, low wage increase rates translate into weaker consumer spending. A key factor in the soft consumer spending was U.S. auto sales, which dropped by 3% in May, contributing to retail sales' largest decline in a year. Weak consumer spending and increased internet sales are also affecting brick-and-mortar stores across the price spectrum. They are closing at a record pace, and it's predicted that nearly 8,640 stores could close by the year's end. Despite soft numbers in February and April, May's existing home sales report calmed concerns that the selling season hit a low point. Still, the market remains lopsided as the supply of luxury homes exceeds affordable housing. Despite low mortgage rates, first-time homebuyers aren't entering the market because of limited property availability. Analysts pay close attention to housing starts as new construction numbers can correlate to increases and decreases in other markets and investments. Unfortunately, construction on new houses fell in May, dropping to the lowest numbers in 8 months. The drop in starts, partnered with a drop in housing permits, suggests numbers may stay low in the coming months. Oil prices experienced a rough first half of the year, thanks in part to a global oversupply. Yet some analysts are expecting prices to bounce back in the third and fourth quarters of this year. Earlier in the year, OPEC announced its goal to reduce stockpiles by June. In response, U.S. oil drillers ramped up production. And when OPEC oil-producing countries did not hit their 5-year average last month, analysts saw it as a chance for the price per barrel of U.S. crude oil to increase. In June, the price per barrel fell to $42, roughly 14%. As we start the second half of the year, oil prices are slipping again and seem stuck under $50 a barrel, with excess supplies and overproduction still the culprit. Now let's turn to global markets. Significant political developments occurred globally between January and June. Despite these and other political challenges, markets were able to record advances. However, continuing issues could create some headwinds for market advances in the second half of the year and beyond. First, the Trump inauguration. The markets were not hurt despite some negative pundit predictions. Whether Trump and the Republican-controlled Congress deliver on healthcare reform, tax reform, and infrastructure investment will influence markets in the future. The French election. The markets brightened as Emmanuel Macron defeated the far right. The new French president is a centrist who supports the EU and may be able to lead French economic reforms. UK Brexit and the election. Britain and the EU need to engage in realistic discussions about the UK's exit from the European Union that should settle markets on this point. North Korea missile testing. Continued missile testing by the North Korean regime is creating more geopolitical concern. On July 4th, North Korea fired the first intercontinental missile, raising the stakes for all concerned. And Middle East unrest. Saudi Arabia, the United Arab Emirates, Egypt, and Bahrain are accusing Qatar of supporting terrorism. How this all plays out could influence markets. The MSCI EAFE measures large and mid-cap stock performance in 21 developed countries outside the US and Canada. And for the first half of the year, this index rose 11.5% from 1,689 to 1,883. And we continue to see investment opportunities both in the developed markets outside the US and in emerging economies. The MSCI EM index performance rose an impressive 17.2% during the first half of the year. The index is derived from large and mid-cap stocks in 23 countries with developing economies in Asia, Latin America, Europe, the Middle East, and elsewhere. Emerging economies are generally making impressive strides to join the developed economies, which comprise primarily of the US, Canada, Western Europe, Japan, and South Korea. The emerging markets are benefiting from a solid revival in global growth. In Latin America, the S&P Latin America 40 index rose 9.86% during the first half of 2017 from 2,748 to 3,019. MSCI added Chinese stocks to its emerging market index last month, reinforcing the increasing importance of emerging markets in the global economy. Overall, emerging markets growth is targeted to increase 4.1% in 2017 and 4.6% in 2018-19, faster growth than currently anticipated in the U.S. This slide shows the Euro Stoxx 50 stock market index performance for the first half of the year. Note the low of 3,231 was on January 31st, 2017, and the high of 3,659 was on May 5th of 2017. This index of 50 major Eurozone stocks from 11 countries is a good proxy for general European equities market performance so far in 2017. The European economic situation continues to improve in 2017. Growth is spread across the region as first quarter GDP surprised on the upside. Consumer consumption is improving, businesses are reporting rising new orders, strong labor markets are showing the fastest job growth since 2015, and European Central Bank is studying how to unwind its stimulus programs. As noted earlier, political concerns lessened when the moderate EU supporter Emmanuel Macron won the French election. And in June, Greece's creditors agreed to additional loans, easing tensions over this long-running issue by avoiding a Greek loan default. Now let's turn to the second half of the year. Remember this slide? The average these analysts originally predicted was a 5.8% increase over 2016. Their revised average prediction is a 9.8% increase over 2016. The actual S&P 500 year-to-date numbers show an 8.2% increase on 2016. Now, we showed these numbers at the beginning of the presentation to give you an idea where the analysts started the year. Earlier, we noted that the S&P 500 recorded its best first half since 2013, improving by 8.2%. Revised numbers now predict a 9.8% increase over the end of 2016. Since January, 7 of the 12 experts revised their numbers upward, 5 stayed the same, and none believed the numbers will fall. This mild confidence in market growth reflects the movement we've been seeing, slow and steady. In 2016, the U.S. economy expanded at its lowest rate since 2009, increasing by 1.6%. Since January through June 30th, the GDP has risen by 1.4%, and analysts are predicting it will hover around 2% growth to finish out the year. President Trump's plan to increase the GDP by 3% seems a stretch right now, as no major economic policies have been developed or applied yet. Healthcare reform, infrastructure improvements, and tax reform are not yet realities and all face significant political hurdles. So, what should we expect? Slow and steady. The dollar fell in at the end of June, posting its biggest quarterly decline in almost 7 years against rival currencies. What does this mean for the U.S. economy? Well, a weaker dollar is good for companies involved in export. U.S. goods are cheaper to make and can be sold outside the U.S. at a greater margin when the dollar is weak. In addition, companies with income outside the U.S. will report stronger earnings as the stronger foreign currencies convert into more U.S. dollars when the dollar is weak. And conversely, a company whose business imports goods from countries with a stronger currency will face headwinds as imports become more expensive for U.S. buyers. Of course, U.S. companies competing with imports may well be helped by a weakened dollar. Consumers are apt to select their products that will be cheaper than imported products. Corporate earnings growth should continue in the second half of the year, with most companies continuing to earn respectable profits. As you'll recall from a previous slide, corporate earnings were widespread and healthy during the first half of the year. The S&P 500 is currently trading near its highest prices in more than 10 years, roughly 18 times the expected earnings over the next year. Analysts forecast earnings growth for the S&P 500 at 11.3% for 2017. How stock prices perform in the second half of the year, given anticipated corporate earnings support, should keep investors interested. The Federal Reserve has repeatedly announced plans to raise interest rates once more in 2017 and possibly 3 more times in 2018. They've already increased rates 3 times since the financial crisis. Despite low inflation, the Fed is banking on a strong labor market driving wages. Analysts and experts will stay focused on this fundamental and watch how increased interest rates and inflation rates play off each other. The Fed also plans to trim its $4.5 trillion balance sheet, which is referred to as quantitative tightening. In the wake of the 2009 recession, the Fed bought up large numbers of mortgage-backed securities and bonds. The act, known as quantitative easing, helped save the U.S. economy from even harder hits by expanding the money supply after the 2008 financial crisis. The Fed now believes the economy is ready to slowly reabsorb its assets. By quantitatively tightening its balance sheet, the Fed hopes to even out financial markets. The Fed has never been in this situation before. As such, investors and analysts alike will closely watch how the tightening affects the U.S. and global markets. Over the next 6 months, we'll be thinking about a few fundamental questions: job growth, employment, and wages. Will low unemployment translate in the second half of the year into wage increases that will support increased consumer spending? Housing sales and starts. Will this sector strengthen in the second half? Will builders be able to transition profitably to housing at prices more in line with the needs of first-time homebuyers? Oil production. Can oil producers really stem production and get prices up? Consumer spending, which is approximately 70% of the GDP. Will consumer spending strengthen in the second half of 2017? Dollar value. Where are the investing opportunities if the U.S. dollar continues to weaken or if it rebounds? Inflation. Will inflation rise toward the 2% goal of the Fed or go beyond? Interest rates. Will the Fed follow through on its intention to continue to tighten money? And the Fed balance sheet. Can the Fed start selling off its $4.5 trillion in assets in a way that does not roil markets? Tuning out political noise while managing your finances is not always easy. And if you leave with one thing today, we hope you remember to focus on the fundamentals. As the market continues its slow and steady climb, don't let your emotions dictate your investing. The economy continues to grow at a steady but modest rate in 2017, and we see this trend continuing. Investing wisely involves more than reacting to soft factors like consumer sentiment or geopolitical tremors. For investing opportunities, we urge you to stay focused on company earnings and opportunities, as well as global economic fundamentals. Thanks so much for your time today. We hope that you enjoyed the information we shared. And if you have any questions, don't hesitate to email us at info@beaconwealth.com or give us a call at the home office at 540-345-3891. Of course, your first line of defense is always to go directly to your Beacon Wealth financial advisor and ask them any questions that you might have on your mind. Thanks again for joining us, and have a great day.